Hey everyone, and welcome back. I am the part-time economist, and in today's video, we're talking about two ways that people try and make money when the stock market is going down, and I want to heavily emphasize the word try to make money because it is extremely risky to bet against the market. It is extremely risky to time the market, and when you follow these strategies, you are doing both of those at the same time. So again, extremely high risk. I know that when the market starts doing crazy things, people look for innovative strategies. So again, I'm making this video as an education video, as an information video, but definitely not a financial advice video. One more thing before we get started. As I'm recording this video, the stocks are down. By the time you watch this video, they could be up 5, 10, 15%, or they could be down 20%. So this video is more of a theoretical explanation as opposed to telling you, oh, you need to go do this right now and capture some opportunity, right? With that being said, there's broadly speaking two ways of making money when the stock market is going down. The first is options trading. The second is short selling. And we're going to talk about options trading first because it is relatively lower risk. Now, when I say relatively lower risk, low risk in this situation means losing every penny that you put into it. And if you're thinking, hey, that doesn't sound very low risk, wait till we get to short selling where you can lose more than what you put in. Yeah, it's crazy. So in any case, how can you make money with options when the market is going down? Well, to understand this, we really need to review the four kind of quadrants of options. So when it comes to options, we can buy an option, we can sell an option, right? If I'm the buyer of an option, I'm paying a premium to be able to buy or sell a stock at a specific price. If I am the seller of an option, I am collecting that premium, but I am on the hook because I've got to either sell someone a stock at an agreed upon price or I've got to buy it. And then, of course, we have call options and put options. So a call option is someone's buying a stock at a specific price. Put option, they are selling it at a specific price. So we've got buyer seller, we've got calls and puts, right? So you can buy a call or you can sell a call, you can buy a put or you can sell a put. Okay. What do I do when the market is going down? Well, again, keep in mind this is extremely high risk, but when you sell a call option, essentially what you're doing is you're saying, look, I am going to charge you a small premium, but I'm going to guarantee that you can buy this stock from me at a specific price. Now, why would someone do this? Typically, the person buying a call option, they think the stock is going to go up. So I'm just going to make up some numbers here. Let's suppose SPY is $500. Someone says, okay, I'm going to buy a call option for SPY at $510. Why would they do that? Well, they're hoping that SPY goes up to $540, $560. So when everyone else is paying $540, $560, they can buy at only $510. Okay, that's pretty cool. Why would we sell a call option? Well, when we sell a call option, we are collecting that premium, right? And the premium can vary from a couple cents per share to several dollars per share. But let's just suppose we're making 10 cents per share premium, right? For 100 shares, you can multiply that out and it's going to be the total premium that we're getting. So we are selling this option, we're collecting the premium. We do not want the stock to go up because if we agree to sell SPY at 510 and SPY goes up to 540, then we're essentially losing $30, right? Because we have to sell it at 510 and everyone else is over here selling at 540. What we want is the market to go down. Now, we don't care how much the market goes down. We don't necessarily need the market to crash. We just need the market to stay below whatever that agreed upon price is. That's called the strike price, just for your information. So if we have a strike price of 510, as long as SPY is below 510, we're making money because we collected that premium and we provided someone the ability to sell at 510. If the stock is 509, they're not going to exercise that option and buy it from us at 510 when they could just buy it in the market for 509. So essentially what we do is we want to sell worthless options, right? And again, keep in mind, when I say worthless options, it's not like we're selling someone junk. It's not like we're taking advantage of them because they're expecting that the market's going to go up. We're expecting that it's going to go down. So we're essentially capitalizing, making money by assuming some of that risk. So that is the call option. And like I said, the higher the stock goes up, the more you are essentially losing out on not being able to sell at the higher price because you locked yourself in to selling at that agreed upon price. So with the call option, you want the stock to go down. Now, let's talk about short selling, which is extremely risky. I do not endorse it. I do not do it myself unless you're some crazy multi-trillion-dollar hedge fund. In which case, if you are a multi-trillion-dollar crazy hedge fund, why are you watching this video? I'm just a part-time economist with a small YouTube channel, but you can hire me. I'm an MBA with a 4.0 GPA, bilingual, so, call me maybe. But in any case, to bring things back to the level of seriousness that I want to emphasize in this video, short selling is extremely risky because there is no upper limit to how high a stock can go. So let's talk about short selling in the best case scenario. What happens with short selling is I say, look, SPY is at $500. I think it's going to go down. I want to make money. So what I'm going to do is I'm going to borrow some shares from someone that does own them, and I'm going to sell them at the current market price. So I sell 10 shares, $500. I make $5,000. Now, that's really cool, right? I sold something that I don't own, which means I have to repay those shares. Someone wants their 10 shares of the SPY. So how do I make money off this transaction? Well, what I'm hoping is that SPY goes down. If it goes down to 450, I can buy those 10 shares back at 450, sell them to the person that I owe them to, and I've made that difference. So 500 minus 450, I have made $50 in profit per share, which is totally awesome. Now, this is where it's a little bit different than options. Remember when I talked about selling a call option, I said, as long as it stays below that strike price, we don't care. With short selling, we want the market to go as low as possible. We don't just want it to crash from 500 to 400, because then we're making $100 per share. We want it to crash down to 200, down to 100, because the wider that gap is, the more money that we're going to make. So in theory, that sounds great. However, the problem for short sellers is that the market does not always go down. And even when it does go down, it can take a long time to go down, all the while they are accruing margin interest, margin debt, things like that. Let's suppose, again, I owe those 10 shares. But now SPY has a rebound. It starts going up in price. Well, when it goes to maybe 505, it's not a huge deal, right? I lose $5 on every share, right? Because I owe someone these shares. I only got 500 for them. I've got to buy them back at 505 to repay that debt of shares that I own someone. But there is no upper limit to how high a stock can go. So if SPY goes from 500 to 600, now I owe $100 per share. And again, there's no limit. So I'm waiting, I'm trying to hold out, hoping that it's going to go down again, and it just doesn't happen. So from a theoretical perspective, right, a kind of Series 7 by the book thing, the maximum loss on a short position is technically infinite. Now, in the real world, brokerage firms are going to have safeguards, right? They're going to start liquidating. They're going to start doing margin calls once you get to a certain situation. So in the real world, your loss isn't going to be infinite. However, in a theoretical perspective, it's an infinite loss. So again, keep that in mind. Extremely risky. So just to kind of bring things back together, when it comes to making money in a market that is going down, there's really two ways that I think of. The first is options, and we mainly talked about call options, right? Which is where we are selling an option, collecting that premium, and hoping that it expires worthless. I didn't even talk about buying put options. That could be another strategy. I haven't really used that. I'm more of a seller of options, but it's something you can look into as well. And then, of course, we did talk about short selling, which has a possibility of massive profit, but also of infinite loss. So key takeaway from this video, it's definitely possible. There are ways of making money when the market is going down, but They are risky, and I highly encourage you to do lots of research, talk to a qualified, trusted professional before doing any of these strategies, no matter how many friends tell you that they're awesome. It's your money, and you should be careful with it and fully understand what you are doing. As always, I hope you enjoyed the video. I appreciate you watching, and I will see you next time.